Taxes is something that everybody hates, but the government actually collects taxes because it needs money to fund its operations. It needs money to fund the building of things like public goods. And sometimes taxes are also used to discourage the consumption of certain demerit goods that the government deems to be socially undesirable but yet overconsumed. Like for example, in the case of cigarettes or alcohol, the government actually mostly places taxes on such goods. Now, when we look at the topic of taxes, we can either classify taxes as under direct taxes or indirect taxes. Let's give you examples of direct taxes and indirect taxes and run through with you why is there a difference between direct taxes and indirect taxes. Why are they called direct taxes? Because they are collected directly from the intended party that they want to collect from. For example, personal income taxes are collected from you, the individual, and corporate income taxes are directly collected from companies from their profits. So, personal income taxes and corporate income taxes are considered examples of direct taxes, whereas indirect taxes are collected through an intermediary. Now, an example of indirect tax would be what we call value-added tax in most countries, or in Singapore we call it the goods and services tax. Why do we call a value-added tax or a goods and services tax an indirect tax? That's because they are not collected directly from the intended party. We go through an intermediary. For example, when you buy something from a convenience store, you do not expect the government placing an official beside the cashier to collect the taxes from you, right? So what they have to do is to collect the taxes through the supplier. So through the producer, they will collect the tax by requesting that the producer pass on this tax back to the government. So in that case, we call that an indirect tax because it goes through an intermediary. Now, all forms of indirect taxes therefore adds on to the cost of production for producers and shifts your supply curve to the left. So, if we examine the two kinds of indirect taxes, we will go with what we call a specific tax and an ad valorem tax. A specific tax shifts supply curves parallel to the left. So it's a parallel shift of the supply curve to the left, and it involves a specific value. Say for example, a $5 per unit tax would be considered to be a specific tax. Whereas an ad valorem tax will involve a pivoted shift of the supply curve to the left. A pivoted shift of the supply curve to the left will involve usually a percentage-based tax. So for example, GST or value-added tax, which is usually a percentage of the total sales, will be considered to be a ad valorem tax, which causes a pivoted shift of the supply curve to the left.